Here we are, just pressed record, Austin, Texas. This is my buddy Rozzy. He's traded 0DT casually for what, 2 years?
Yeah, I'd say about 2 years.
How's the success been with it?
It's been up and down, We've
That
got
is.
good months and bad months,
We
but
played the MEIC game for about a year, which didn't work. Then we adapted and kept cruising along.
yep. I actually gave up and ended up putting all my money with MBH Capital.
Yeah, it's the FOMO and the size of it, but Rozzy's taxed very heavily as a California resident, so he plays the Roth relatively well.
I do. So, I just like having Mark, control everything, and then that way I don't need to be, because I have a full-time job, so, I'll used to be in meetings and...
How was it trading while working full-time? Throwing around
Not good.
70% of your net worth in zero-day options?
Not good. I would be in these serious meetings and I just couldn't pay attention because the S&P could be 5 points away from stopping me out on a big position. So I just learned to delegate that responsibility to MBH, and now I work stress-free.
Yeah. The other thing that we've had some fun with is what we call Superlots, which are the 5-cent wings from the credit spreads that we sell during the day, or some long puts that we hold overnight. Rozzy once had about a 25% account gain, realized during the Iran-Israel thing. I called him up and I was like, what do you want to do with this? He let the Superlot ride and all the profits decayed.
Yep. Unfortunately, that night I was sitting on a pretty big gain, and we thought we'd ride it out until the market opened, and unfortunately we lost that gamble. But
yeah, the other thing too is like when we first started trading, I think it was like most people where we had 50 to 100 grand accounts and we leveraged them a lot, and it does work. And over the course of a year, I think you get 60 to 80%, but you also have those 20% drawdowns when you question,
does this actually work?
Yeah. And I think the trend with that is it does work, but the edge is small and the leverage is big. And that's kind of where it all is comprised from. And it's hard to do that when you're not really into it. We got you going on Options Omega a little bit, and you were discretionarily trading some far out of the money stuff. How was your experience with that?
No, I wasn't buying out of the money calls.
You were selling far delta credit spreads.
Yeah, I was. High probability of success
In the low
trades,
VIX. What
which
was
I
that?
like.
What was that trade setup?
Mostly iron condors, but also call and put spreads.
What credit and stop multiple?
Credit, I think we typically used a fixed dollar amount rather than a delta. Maybe around $1, sometimes 50 cents for the far out ones, and then the nickel wings.
And it worked until it didn't, right?
Right.
Yeah. The underlying trend I see a lot with 0DT is that a lot of people may trade options. I don't want to say they get lucky, but they can take large bets at good timing in the market and they have large success, whereas you can do that in 0 day also. However, you'll eventually get bit because the amount of occurrences is just so fast and large that the pricing in general is extremely accurate.
Yep.
So what about the FOMO of the general market? You're sitting on 30-something% gains in 0DT, which is just nothing compared to the big tech stocks, especially being an SF guy, right?
That's right. Nvidia's up 170, 80% or whatever the number is, and sometimes it's tough not to get FOMO when all your friends that
Are idiots.
barely know
Yeah,
anything
yeah.
about investing are making doubling, tripling their money, and you're sitting here with a 25-30% year-to-date gain, or
Yeah.
whatever the case may be. So yeah, it's a tough year to compete with NVIDIA and a lot of semiconductors and everything that's getting a boost from the AI boom.
Yeah.
So we watched the presidential debates last night.
We did. It was.
What do you think are the implications if we get a Biden or a Trump presidency on the market?
I think that it's going to be bullish regardless. We're partying on this debt until we basically pass out from debt poisoning. I think that Trump may be a little worse for 0-day stuff because he tweets, which could cause some market volatility. However, if Biden gets elected, he's pretty old. So if he dies, that could be a pretty big black swan event that is not priced into
Right.
the market. But the debt and reward for people just taking risk and financializing everything across America, I kind of call it like the London syndrome, where the UK is actually very poor and doesn't really produce anything economically, except London in itself is like this money changing financial hub where all the wealth and economic activity and power is kind of centralized. And I think with San Francisco and New York, that just further gets compounded, and people that are playing the debt speculation game just continually get rewarded. I'd like to see rates just stay where they are effectively indefinitely, because it prevents a lot of bad actors from the marketplace.
Yeah, I wonder if based on the current world environment, and then potential Trump presidency and the tweets like you mentioned, and then Biden and the risk of him just dying during the presidency, feels like there's an increased risk for black swan events in today's age.
I mean, yeah, let's kind of go with the black swan. Like the black swan thing, I think there's two parts to it. Whereas people would say like COVID is a black swan, which I almost don't really agree with, because it was somewhat clear for a period of time like what was coming our way. And it's like 2008 was also somewhat clear of what was coming our way. Even with Russia invading Ukraine, it was somewhat clear of what was coming our way. So people that are strategically invested, that are compensated for volatility selling, I think are actually benefited from that. Whereas what I would consider a true black swan would be like the flash crash in, I don't know, I think it was 2011 or 2013 when the market went down 7% and came back up, or like Trump announcing that we're shutting down the entire economy in 2020. But those all happened after market hours. So I think that volatility instead of black swan is a better way to say it, because with a black swan, we actually have no idea of what it will happen and why it'll happen. And particularly in 0DT, like our risk to what that looks like is very muted, because we have resting orders within the market. And then if those were to get stopped out because they're already broker resting, even if you may eat 1 or 2x credit of your stop and premium, you're now all of a sudden like 100x notional with nickel wings that are 2 or 3% of the money, which even this year has occurred. And I think this is a good proxy for the powder keg of vol. It's like there's probably been 3 days where nickel wings paid like 150x of what they were. So that's an interesting market dynamic of what that looks like. But yeah, it doesn't make sense, the speculative nature of NVIDIA and AI and whatever that looks like, and how long it could go. It could be years or whatever. But the election, I think, could bring up volatility, which I don't know if a lot of people will remember, but futures went limit down when Trump got elected in 2017.
Right. Yeah. Yeah. No, I remember. I think it was either December or January. And I was on a trip at Jackson Hole going snowboarding, and there was some kind of event. It wasn't a black swan event, but there was a large.
It's a volatility event, is I think the better way to describe it.
Yeah, and all my nickel wings, like, I ended up having a huge gain that day.
Yeah,
and we were texting back and forth, and that was one of the first times the nickel wings actually paid big.
The Superlots.
Yeah.
And it's crazy how those are actually mispriced. And like you're buying $1 of exposure if those nickel wings go in the money, which rarely happens, on a $500,000 instrument is, $100. So all of a sudden, you are holding 20 times your account size on a $500,000 instrument with nickel wings, and like that follows through. It's a pretty insane return potential. You're like positioned like the big short guy of what that would look like. But I think what a lot of people may not be thinking of is they'll manage the spread, which could cause slippage, or they may have a missed potential order. They don't have any longs. And the point of those is not necessarily to make money, but to offset any unperceived move. So like you're naturally behaving in a way that's positioned long gamma by trading 0DT irregardless. So you think you're going to pick up the keyboard again to trade 0DT?
I don't think so, because I work full time.
What if vol gets good and you get FOMO again?
Then I'll increase my account size at MBH Capital.
Yeah, that's it. You're not going to play it?
No. I'm happy paying a fee and not having to worry during the day.
What changed,
Well, it used to be like very interesting, and I was in between. I do financial reporting, so I have busy seasons and slow seasons, and in between my busy seasons I have a lot of downtime, and it was very interesting, and I had the time to invest in backtesting and whatnot. But then once the busy season comes around, just having the additional stress of the market and trading is just not something that I wanted to deal with.
Yeah.
So that's, I think, the next busy season that came up, that's when I had the realization that this is like, I'm working 2 jobs at this point.
So what do you think of MEIC? Do you think it's dead? Or was it ever alive?
MEIC, I don't think I think I was just breaking even. Like there was never really a risk of a huge drawdown.
Yeah.
But the gains were also marginal from what I recall. So yeah, it's hard to do that again when you have, the way I see it, just investing in the S&P 500 for someone who doesn't want to take on any anxiety and they already work a lot. That can be, a stress-free way to play the market.
Yeah. The other thing I'm working on too that I want to eventually really share with people is like some type of return stacked portfolio. I know we had spoken about this a little in the past, but effectively what the return stack is all these large global macro long short hedge funds. It's relatively easy to tell their positions on short bonds, long bonds, pairs trades on the curves, or long S&P or something. So you can access leverage through these ETFs of them holding like 40% of their shares in the S&P 5% of their capital in ES futures, and they basically created a situation where they have $1 of bond exposure and $1 of S&P exposure for $1 of actual investment. So if you can like leverage that responsibly, you're obviously going to get twice the volatility, but bonds don't really have much volatility in them in general. And you've just created a pretty good investment where you can keep your static exposure. Like if you were to buy a house, you had like 200 grand in the market, you could take 100 grand out to buy a house and then have 100 grand return stack, and you would have kept your additional dollar cost exposure, because it's similar to like the US debt, where if you, deficit spend, so there's money in the economy for people to buy monkey JPEGs, you're not going to get a very good return, which is like buying NVIDIA calls. But if you're just leveraging a US Treasury with the S&P, it's like you're probably actually using the debt responsibly, especially when you're younger, and you can take a little more volatility in your portfolio, especially in a retirement account when you're not going to be withdrawing any of that. I think that's good. And then as well as option bots, I think could be a nice skew for a lot of people to bank it. But what do you think about the cost of living, or the game of, we're seeing people make buku bucks money on tech stocks? Not so much that they're buying them, because, they are taking risk when they do that, but they're just rewarded like ESPP shares. And it seems like we're very divorced from what is actually productive and how people are getting rewarded on it, and like nothing seems to be strategic. And every time there seems to be a little shakeup, they get bailed out by just the cyclicality of what it is.
Yeah, it's a crazy world we live in.
It is.
A clown world where, like you said, people are getting rich off monkey JPEGs.
And you go to Europe and it's like really, really cheap, even expensive parts of Europe comparative to not expensive metro areas outside of New York or SF, like even just like Houston or Fort Lauderdale compared to London and Paris, which are like the world-class cities of the EU, or like they're significantly cheaper.
For sure, yeah. Well, I live in SF, and the whole Bay Area is super expensive, as you know. I used to live there. So as I've grown up there, so I'm used to it.
Yeah.
But for, an outsider coming in, they're probably like, no thanks. Stick to Houston.
Yeah. So what else on options, dude? Do you understand it when you were doing it?
I had a basic understanding for sure. When you're talking super fast about it, it doesn't always all make sense, but yeah, I had a pretty good understanding.
What do you feel like that understanding was? Like, if you could describe what you were doing in 0 day to the common man as a common man, like what would be your elevator pitch for it?
I don't know if I have an elevator pitch, but I could just describe, if they know what like a call option is for starters, the right to buy 100 shares at a certain price by a certain date. And then instead of selling a naked call, we would buy the nickel wing as insurance.
Is it clear there's edge in selling credit spreads
versus buying, or what?
Just in general, like, do you think that credit spreads are a consistent source of edge? Or do you think there needs to be some type of discretion or signal to really have anything that's meaningful with that?
Yeah, I think it depends. Like, I think you could have a profitable credit spread strategy, or you could have an unprofitable one. Like, it's a lot more nuanced than that.
Yeah. When were you the biggest believer in the 0-day life?
I don't remember the exact time, but running the back tests, and just playing with the back tests, and then looking at the CAGR, the compound annual growth rate, and the MAR. I forget what that stands for, but it's like the kind of like the risk of the trade. Seeing some of those back tests and just playing around with them, and then you can do enough filtering where it's like, oh my god,
yeah, you can curve fit it. Yeah, you're like, NVIDIA's got nothing on me, and then you try and do it in real life, and you go,
exactly.
Yeah, it's like risk in theory versus risk in practice, or if you can't execute it, it's a problem.
Right.
I always like to compare it to kind of working out, whereas you think you have this big plan and you're excited, and then you start to get into it and you realize that you were just thinking about being the really good looking muscular person, but you didn't realize that to do that the day in, day out it's
a lot of work,
and high up and lows with it.
For sure.
So I don't think that's much different than a lot of things, but it's always interesting to look at the difference between those two.
So what's your trade that's yielding the most, I don't know, CAGR or MAR?
I've been getting really into portfolios. And then I think the other thing with portfolios, if we think of the edge being derived from options margining. So basically what we're doing is we're trying to find something that is consistent with a, nice P&L curve. And then can you offset that with kind of the convexity of some longer trades? Like I've recently kind of realized in more depth that calls, even not in a bull market, because there's bear runs, buying calls is a very profitable strategy, and selling calls is a pretty tough living. So as we go kind of with the portfolio thing, if your credit trades on the call side, you basically look at as these are just financing my long calls until the long calls pay, I think is very beneficial. And then also when we start to compare in this low volatility environment, I don't like to use any discretion in, how I operate a large portfolio. But in regards to that, there are clearly trades at the open that, you can get far out of the money and have relatively large stop multiples that, especially in choppy markets, are extremely consistent. And you do not have much risk to the upside because you purchase those calls. So by pairing overnight exposure with long options and short options with high stop multiples, because those are offset by the long options, at least on the upside, and then doing the same at the open in the morning, and then having very small stop multiple, basically MEIC type tranches throughout the day. The key with those is that neither of them have a very responsible, large return. However, in 0 day, if we just think about the options margining, and then the difference between arithmetic and geometric means is basically arithmetic would just be like making $100 a day, lose $100. There's really no compounding or downside volatility tax to it. Whereas arithmetically, if we are compounding to the upside and your drawdowns are small, around 5-ish%, you're getting all the benefit of the upside compounding and taking none of the drag of the downside compounding. And then the short-term time frame of you rolling over those options every single day with access to that leverage and being able to mix several strategies. I think a lot of people miss if you have a strategy that may only make, you size it for 4 to 5% a year and it's been consistent for 5 years, and maybe its max drawdown is 2%. Well, if that strategy is put on at the exact same time as a credit trade and it's a debit trade, and they're basically tied to each other with a stop loss or a profit take, that's uncorrelated, And if you size it responsible, like you're going to have a -4% max drawdown on the credit trade and a -2% max drawdown on the debit trade. Just size that for 10%. Basically, with the two of them together, you have like a 2% drawdown, and you find 3 or 4 skews like that. And that's a very consistent 40% with a 5% drawdown. Whereas I see people in different market environments just trying to change the parameters on a credit trade or trade one time that's really, really good on a credit trade. And all you're doing is, even though that return's good, like an 80% win rate trade, just because in the last 3 years at that time, it hasn't had 5 losses in a row, like probability wise, you can have that standard deviation. So you're really using discretion and you're not playing a math game. Whereas the benefit of just arithmetic upward compounding and like reusing some wings every time and having that benefit of the convexity is a huge hack. And it's really hard to do because your understanding needs to get better and better as we add more variables in a portfolio. And I think your assumptions also need to get more and more conservative. And the way to tell that is if you're actually hitting your projected returns and backtest, then your assumptions are conservative. Whereas like what I like to tell people is if you make a portfolio and it hasn't traded every day of the week for 5 years, and you actually have trades that are uncorrelated, not just a 10-15 credit spread doesn't lose when a 12-30 credit spread are, you're going to get whatever your drawdown is within 3 to 6 months, probably double what that drawdown is, even though that's 3 years of data. So all of that, I think, is where people have really screwed up, or the fact that just your cost of getting in and out of spreads is probably 20% of your profit. So people are very liberal with what that cost is. And that is almost a larger source of profit for an assumption than the entire trade. And this is where I see a lot of people mess up, but it's much more difficult with a smaller account. And when I say smaller account, I mean like something that's not 1 to 2 times the size of the S&P. So like $500 to $1 million. It's really hard to size these 4% CAGR trade longs with 10% CAGR trade short options so that they actually offset each other. Because if you're just like, these aren't correlated, I've listened to Mark, I've found a way, and then all of a sudden you round up from a 2.3 lot would offset it to a 3 lot, you just played the same game of picking the 10-15 slot that just hasn't lost. Like you've introduced 60% more standard deviation or variance to outperformance or underperformance, which I feel for a lot of people because I frustratingly had to deal with that for a long time. And you're like doing everything right, but you're not getting the results you thought you were, just because the inputs, even if your assumptions are pretty good, are off, which really kind of sucks. And I think that's been shown more as the edge has gotten smaller, not because DT is overcrowded, but more so because the volatility spread between realized and implied is just lower, close to 2017 lows, that all those assumptions and flaws with trying to do it at a smaller size are just compounded, and it makes it really, really hard. And the fact that almost all the benefit in 0 day comes from the compounding and your assumptions off, which brings down the compounding, and then the environment's off, which brings down the compounding. And all of a sudden, like, you're not even doing what the NASDAQ is, and you've spent way too much time worrying about it.
Right. So if someone did have a small account and they wanted to trade 0 DTE, what would you recommend?
I'm trying to actually do it. So there's this guy that I work with, Connor, and I'm YouTubing through the steps. I honestly don't know how it's going to work out, because when I used to trade 50 grand accounts, I was pretty discretionary and had long drawdowns and stuff. But I'm excited to document it with how much I've learned over the time and responsibility and being able to dedicate full time to it. Like, how can I responsibly make a portfolio that is 50 grand consistent to make money? And the few assumptions that I've taken in is like Connor will be a sounding board for me that can responsibly dumb down what I need to say because I kind of go over the top. But also, I think there's a lot of merit to not diversifying at that size. So if you had one trade that works, you shouldn't add another trade, especially if it's like 0.5 as much correlated. So what I was playing around with him is that the open is a good time to trade because there's more volatility. And when you have a small account, if you go like 100 wide, it doesn't use up a crazy amount of buying power, but you're far enough out of the money because there's enough volatility even in low vol to where you can afford to pay 25 cents for a wing or a spread and manage it as a spread, especially if you use a big stop. And then we do need to be diversified. And what I think diversifies from that is that you have like a calendar trade because they're really capital efficient because they're debits and they can basically go on without any filters or parameters. You can roll over the money really quick. And if you get days where the market ping pongs up and down a lot, it just matters how the day finishes on calendars, which obviously isn't the case with credit trades. So I think that is probably the best route to go for a small 50 grand account. And I'll share this with everyone. And I do think that being mechanical like that, which would be someone like you that's working where you could just set it and forget it, I would recommend people trade steward because it's on AWS. You don't need to turn it on or anything at all, even though I believe TAT is a much better function for trading credit spreads on 0DT, is that 40-ish% of return with a 10% drawdown for everyone consistently every year, I really think is doable. But I'm curious on how that's going to go because I've been messing around with it. I'm going to let Connor go on it next week. And I've been struggling a little bit with trading at that size to get returns, especially with the market just continuing to gap up parabolically. And I think that spending money for the drag of super lotto calls is actually something people should be doing in a small account. Because by buying the super lotto calls, it's a way to get, a 20-ish% return with a 5 to 10% drawdown, but it's really capital efficient. So just taking advantage of the market that goes up so you can't really lose to the upside. And then if the market goes down, there'll be more volatility to where credit trade should work again, I think is the route for that. But yeah, we're going to try and take a 50 grand account to 100 grand in like 6 or 7 months.
Have you considered maybe for a small account trading the SPY with commission-free broker or something like that?
I did it a little bit on Options Omega. I don't think it would work well for 0-day stuff. I think that would be a good option for buying the call. So it's just smaller. And I've been listening to some guys too. It's like single stocks are interesting, but I've just lived so out of that world that I have never thought of it. But I do think that you could make some money in SPY for sure. At a more responsible size. But the thing that I don't like about it is like you could get assigned and then that's just something you have to worry about. Or like check.
Oh yeah. I wasn't thinking about
I think a tighter spread in SPX would always be better, but buying like the long option, I do think that SPY is a good opportunity for that. And then maybe exercising some discretion for the smaller accounts because you have to have fun, but defining what the guardrails are for that.
Makes sense. What else?
I don't know. I mean, I like talking options, but now that I'm not walking you off a cliff, to keep trading, it's not as dynamic. You've mellowed out a lot in all areas of your life now,
I certainly have.
It's kind of impressive.
What do you mean by that?
Just your demeanor, your choices on like job and career, that it didn't need to be as big or as fast.
Yeah.
Like you seem very content. It's kind
I
of
am.
it's a relaxing posture, you know, like a much more that tale when there's like the buffalo and they're like, let's go down the hill, and he's like, no, let's walk down and we'll do it all, you know. And I think that really is the shift for a lot of probably more definitely guys, but it makes a huge difference. And I know we were talking about this yesterday is people will kind of hold on to their beliefs. They're just like, I've been an accountant for 20 years, or I've been doing this for 20 years. And it's like, sure, that provides experience, but the thing that also kind of tells me, if you haven't progressed a really long way, is that you're just learning the same lesson, or you have not yet learned the same lesson that's presented yourself 30 or 40 times, where it's like, everything's not a competition that you have to prove yourself, or this is where I'm at and I'm not trying to be something for someone else, and I'm happy and content with what that is. That's the psychology of a good trader, you know?
Yeah.
And it's funny that you like live your life like that now, which is like the one skill that was probably holding you back beforehand.
Yep. I definitely used to always want to be rich, as most people do.
Yeah.
But if you think about it, the way we live today, I mean, compared to even 50 years ago, you know, everyone's a lot more well off. So, you know, I'm happy, and I don't have to compare myself to people with more money. And
You never had to, though.
no, I didn't.
Yeah.
But I was. And so I would always, you know, try and get involved with some kind of get rich quick scheme,
Yeah.
or just I've learned to accept the situation I'm in, and you know, play the long game.
If you play for decades, I think everyone can win. And I also think a lot of people are very content at the latter end of those decades because of who they kind of are and what they can do, rather than the means of what they could potentially do.
Right.
Yeah.
And it's also, you know, I put a lot of emphasis on, you know, health is wealth, and, you know, working out, getting enough sleep, eating right, and
Don't you just like have some vigor though sometimes, and like roll out of bed too early, or just like want to get after it? I can't suppress that very well.
I do during busy season, and then during the slow seasons, after a couple weeks, I'm able to mellow out, and I go on trips. Went to Europe a month ago. Yeah, I lost my train of thought, but yeah, I playing the long game.
That's the game everyone should play.
Yeah.
It's just how you want to play the long game. We've got 20 minutes left.
Oh yeah, what I was saying was emphasis on health, and then, you know, just having time for, you know, my fiance, or to visit family and friends and stuff. And if you're grinding too hard, you know, you might lose a lot of those relationships that later in life you would value more than you do when you're young, and you're just trying to, like, you know, get your business to a certain level, or whatever the case may be. Like, you'll be grinding super hard, and you'll put a lot of things on the back burner. And so I'm trying to live like a more balanced lifestyle, whether it's socially, health wise, and then, you know, my work, I work like half the year or so, and it, for the Bay Area, it's a pretty good.
When did that shift kind of happen? Was there a moment, or was it just a slow progression?
I wouldn't say it was a moment. I think it was a slow progression, but yeah, I don't know what it was. I just stopped. I just took a second to compare how we live to, like I was saying, people that lived 50 years ago, or even people in other countries. Like, we live,
or even people like not in the Bay Area.
Yeah, yeah, like some.
Some people don't have AC, dude.
Yeah, exactly. So, for us to sit in a San Francisco apartment, and we've got pretty much everything we need. Maybe not everything that we want.
Yeah.
But everything that we need plus more, and I'm working from home, sitting on my nice couch. I can just click a few buttons, and then someone will drive some food out to me that I didn't have to hunt for. I didn't have to cook the food. It's like, we're living pretty good.
So what's the main avenue that you like to, I kind of call it the masculine tinkering, like you're fixing something, whether that be on a computer or to make money or like in your garage, or you have like some type of competitive outlet? Because it's like, doesn't sound like work's getting that, which is fine. I don't think most people should get that from work. It's like, how do you express that tinkering with something or some type of competition in your life?
That's a good question. I don't know if I have that right now. And that's something that I'll take away and have to think about.
Yeah, I feel like a lot of people resonate to it. It's like when we go back, I'm all for the gratefulness and the balance, and you can, justify that to yourself of you have the gratefulness to provide for your family, or like the gratefulness, the opportunity to do whatever in your business. But everyone kind of needs some type of competitive outlet to grow in, especially guys. So kind of picking something like that, I feel like evens out the balance and everything. Like you can be a lot gentler in other aspects of your life when you have that outlet to kind of sand the rough edges of, your maybe wanting of like powerful or freedom emotions.
Yeah, that's a good point, because now that I'm no longer really competing with my friends for how much money we make.
Yeah.
I don't even know if I used to do that, but you definitely think about it, like, oh, how much does so and so make, and then
you think about what could life be like,
Yeah.
Yeah.
But now that I don't really care about that, there is not a whole lot of competitiveness in my life right now, which I don't know if that's necessarily a good thing. But
yeah. And you could get it from like kids soccer teams too.
Exactly.
It doesn't need to be sports. Like it doesn't need, but watching the Warriors game is probably not the best way to get it,
No, not at all. Yeah, you could get it from sports and not have to commit as much of your life to it as you would to like outwork someone in your career.
Yeah.
So that's probably a good thing to think about going forward, is where am I going to get that?
So are you ready? You ready to come to Tony Robbins' event?
Yeah, you've been asking for years.
Yeah,
so I think it's about time.
You serious? We've got it on camera. You're down? There's one in November in New York.
All right, let's do it.
Okay.
Manhattan.
I think it's in. It says Jersey, New York area. I don't think they've announced the venue, but just so it could be more attainable to people, I highly doubt they'd have it at Manhattan Convention Center. I would assume probably like Jersey City or wherever the not expensive convention center is. But yeah, it's a cool event. Probably get you where you need to be.
Yeah, we file a 10Q in early November. So starting like the second week of November through like basically February, I'll be off
Yeah.
Yeah.
Nice.
And who knows where you'll be at that time, but maybe I'll come out for a visit.
I think I'll be in the States.
Okay.
I think I'll be in the States. But where in the States, I don't really know quite yet. Probably here. It all depends on what happens in the world of 0DT.
Yep.
I feel like I'm kind of on a boat and 0DT's the ocean. And that's kind of bringing me along the way of where it's gone. I can throw my sail up and direct it a little bit, but I'm still at the mercy of the direction of the wind and the turbulence of the seas a little bit.
Are you moving to the Cayman Islands anytime?
Not Cayman Islands. Not Cayman Islands.
What's the I forget what the tax benefit is over there. There's
I think
a lot
it's
of hedge funds are registered there. We used to audit hedge funds when I worked at Markham.
they can take like money from other places that's a lot more lax. And then right now with a fund, if you're US registered, the states holds back like 10 or 15% of the income of international people. Granted, most people that are international don't pay any money in their sovereign, but I think that's the main benefit of it. Whereas there's a lot of other stuff. However, the thing that I've kind of been thinking of is like prop firms or other like SMA accounts are kind of interesting for people out there searching for new managers or capital. So I always find that kind of interesting that you're just solely focusing on trading. But the level of intelligence out there from the democracy of information is pretty massive. And the market for capital is as competitive as the Olympics or professional football, except you don't have to be 6'8", run 4.4s to play it. So it's definitely an interesting array of market out there. There's sharks.
Definitely. That's what you get with capitalism.
Yeah, it's real and it's pretty efficient and competitive.
And it builds a lot of, new technologies and whatnot. What do you think about, I think I watched it's like a clip from Elon Musk saying we need less people in finance and more engineers, less people just speculating on.
Yeah, no, I really agree with that because a lot of things, the reward system has been set because like the cheapest way for the government to create wealth, which creates domestic spending, domestic spending is one of the best things economically for an economy, is just through capital and balance sheet gymnastics. I'm sure you're familiar with that, and I feel like in the 70s, it was like nuclear engineers. People wanted to be engineers and work for Lockheed and work for defense and actually build stuff. And it's like now our brightest minds are learning how to exploit 14-year-olds on TikTok.
Yeah.
So yeah, that's the reward of the government and the lies of Silicon Valley. And it's like, even with AI, it's just like, okay, cloud computing companies are making money, microchip companies are making money because they're selling the shovels. But basically, AI switched from big data to like gig economy with Uber Eats and Nextdoor to effectively now like AI, and almost all AI startups are just a ChatGPT plugin. So they provide no value and they just spend a bunch of debt money, which beefs up assets so VCs and private equity firms can flip them to the common man public offerings, and then they go away. Like I hate corporate tax cuts because corporations just buy back their shares, and then the second the economy rolls over, all of that wealth just evaporated into thin air.
Yep.
And that only really helps. I mean, it trickles down to regular people, but when it loses, the trickle down stopped and barely anything trickled down, and people just like lose their jobs. Like when I was in construction, it's like we were just building really expensive offices so people could feel significant in San Francisco for people that got fake money off of, making some product.
Oh, okay.
Yeah. And it's like, even with tech stocks, it's like they multiply their earnings by like 10 or their, not even their earnings, their sales, and they call that a valuation. It's like they're only an evaluation for investment, which means that they're worth $40 million on paper and don't make over 200 grand a year in dividend or salary. And then it's not actually worth anything unless you start doing like 10 million in sales and it's worth over 100 million. So it's like we're rewarding the bright minds for the wrong thing. And it's like that just comes down to guys do everything for women or wanting to get women, basically. And it's just like that's the carrot that we've placed in front of people to do things.
Yeah.
So we need to shake out that bad actors with a change in the economy. 2022 was a good start, but that's really what needs to fix it. And we need to not get bailed out. But also like bailing out's nuanced with too big to fail, because you heard a lot of regular people that had nothing to do with it. When that happens, but at the same time, it's like if your solution to fix it is just introduce capital into the market and then speculators restart, that's also not sending the right message,
Right.
And making it harder and harder to go away from it and such.
So do you think we need higher interest rates for a long time to filter out speculation?
Yeah,
Like,
and I think it's started because a lot of VCs and private equity firms and real estate firms are holding a lot of assets on their books that they're going to write off over the next 2 or 3 years that are effectively already worthless. So as those happen, the returns for their investors are not attractive, and people will kind of pull money basically, but they will try to push that out and refinance the stuff. But by not taking rates down, unless something blows up, I think is really necessary, because if things start to roll over and you dip rates, people are just going to revalue shit on their books from public accounting audits. And then all of a sudden they just got bailed out from all of their assets. So I think that stuff, and also like 5.5% rates is not high. So
No.
we should keep these there till like Timbuktu and just keep rolling with that.
Yeah, because Bitcoin's at 60 plus.
Yeah,
1,000,
like
so,
if Bitcoin gets 100,000, like we've got problems economically.
Yeah.
I think that's a good proxy of like people doing nothing for something. And the other thing I've thought of too is I don't know where I read it. I think I saw it on YouTube, but it was like in 1900 there was like 50 million buffalo in the US and like 500,000 cows. And then now there's like 50 million cows and like 500,000 buffaloes. And the difference between buffaloes and cows in a storm is during a storm, the cows just sit there and the storm just comes over, and then buffaloes walk into the storm and they end up getting through it because it's faster. And I think that's a really good synopsis of like how people behave nowadays and what they're rewarded for. And cows are also usually steer, which means they got their nuts cut off. And in our, like the past generation, it was like buying real estate worked as a baby boomer, working at the same company, and just like dollar costing the S&P worked. And it's like, we've had 2018, 2020, 2022 in our economy. And the people that have been rewarded in our generation, for a lot of it, are on speculative things that they did something for nothing,
Right.
like Bitcoin or high flying tech stocks
NFTs.
and yeah, they gotten paid on free unemployment. So I think there's been a systemic change, and everyone just loves to change jobs and we're rewarded for it. So I think there's a systemic change in appetite for asset class that goes towards speculative. And since there's going to be demand from a market with us, because it works and that's what people want, I think it's going to continue in perpetuity. And I do think that things like Bitcoin or AI or Uber gig companies will continue to just kind of rip. But there will be some type of 2008 moment. But the important thing to know about that is like you can't be Michael Burry and wait and think that it happened.
Right.
You just have to know like what's your neutral that you are protected enough not to get burned if something rolled over, and how can you responsibly create some type of income from yourself, whether that's a small portion in that or doing something else that you feel confident in doing.
Do you think we're misallocating resources then if a lot of people are putting their money towards speculation instead of like, I know you don't think we should be doing a lot of
it works, but that's what is rewarded.
Yeah.
So like by us having low rates and letting private equity and VCs have these terms, like that's kind of what works. And it's like, as someone that runs a fund, if you look at like private equity, they could buy a grocery store and then lease back the real estate for $50 million or something. And basically they could just refinance a few people's pensions. And then that asset can basically break even and go under after 10 years. And if they broke even on that $50 million asset just from raising their rent, like those general partners made 2% of that a year. So they basically made $10 million on breaking even for an asset. And they also pay taxes that are like 1/5 of someone that's actually in labor doing that, or someone withdrawing money for their 401k. So just with that being there, it's rewarding people to play in private equity. And this is essentially what Alex Hormozy started doing because he recognized that. And we were talking about this morning, but like when Britain Brexited, private equity just came into England. Everything was discounted from when it used to service the EU. And they just all bought it up and then just kind of gutted because more stuff had to be domestic. And then they could just, we don't really need the multiple because it was an attractive multiple to buy, and we can break even and get a great 2 and 20 fee off it. And France has an election this weekend. There's a little volatility priced in, but it's like a similar thing could happen with the French economy.
Right.
And I think a way to think about private equity is I don't want people to think I hate it, but it's like, it's the predator of the capitalist economy, and it's necessary to weed out bad companies. Like I wish private equity would weed out Ford, that the taxpayers are effectively just still supporting. But when we make the rules of the game easier for the predator to come in and take out the weak, sheep of the herd, I think that's where the reward system is gone, or like VC invest in this, it's worth 10x multiple. We offer it to the public marketplace at 20x multiple. People buy it and it goes up and then they roll it over. It's like, or stock compensation is a non-cash expenditure on a balance sheet. And then like, if you're a microchip company and you build a fab, you like have to realize all of that and pay taxes. It's like those type of rules are just benefiting financiers and balance sheet gymnastics people and people that aren't doing stuff. And that's also why I like Elon, regardless of what he does. It's like he's congruent with his messaging and his behavior, even if you don't agree with it. Whereas like Trump's obviously not congruent with his behavior, Right. But yeah, I don't think it's going to change, and people will continue to play that game until they don't want to. But within that game, there are a lot of really good actors, which is probably like 10% of it. And those people will just eat up the vast majority of it.
What do you think about us importing a lot of our goods from overseas, and do you think that'll continue in the long term, or will we start manufacturing stuff in the US?
I'm not as versed on that, but bringing goods from outside the US is a very strong product of us being the reserve currency and having a strong dollar. Because like it's just really expensive to manufacture stuff with dollars and pay for it in dollars. Whereas a lot of other countries around the world, like Turkey or something, they have like a fake exchange rate for dollars and Turkish lira. And if you go on the streets, people will take dollars and give you way more lira. So it's all interconnected and it's a global problem. Like we are just kind of stronger and more efficient comparative to other economies and other dollars or pounds or sterling or, lira, to where it creates that. And then, as much as we import goods, we export American dollars and private equity to England and throw it back to New York City.
But could we be like doing more productive things than financing, speculating, and then having, people deliver food and drive people around and actually be like building stuff instead of, all these other things that don't create.
It's harder. So I don't think we're going to be doing it as much because, and also like domestic spending is the best source of an economy. So like if we decide to produce microchips or like keep on pushing defense in the US, and because we obviously manufacture all that stuff in the US, like I think that obviously makes sense, but I don't know if we should have people in Minnesota be making hammers that we purchase at Walmart.
Makes sense.
Because I don't really know what that does. Whereas like financing, it's good. And I think it also attracts a lot of brain drain from the people around it. So as much as we may pay for people in the US not manufacturing stuff, because we do unproductive financing stuff, we also attract really bright minds from other countries that want to get rich and do financing stuff. So that's like and they pay taxes here. So that's a valuable conglomerate of it. But I really don't think much about this. I kind of just only think about 0DT, which I think is kind of an important takeaway to just like focus on what you're good at. If you get FOMO or whatever that investment is, it doesn't have to be 0DT if that's real estate or makes sense to a lot of people. But the aspect of things being valued what they actually are, which is like 0DT is cash settled, you know what it is, the rules are set, and that it's liquid, I think are two very, 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 very components of your ability to build long-term wealth is liquidity and actually having things that you know what the value is and can't just parabolically like disappear or be marked at different multiples is a really strong driver to wealth and reacting to that when you have the opportunity.
I would agree with that.
Yeah. All right. We've potted.